started since some people do have to jump off. So thanks for coming today, guys. I have been chatting with Brad from Spectra Capital for several weeks now. They have a commercial debt fund that I think is really interesting, and asked him to come talk to you guys about it because I personally love it. So he brought the CEO, Chris, with him. And so, Chris, it's nice to see you as well. And they're going to tell you a little bit about what they have going on, and we can talk after the call or in our next meeting about whether anyone wants to move forward. But personally, I can say that I do intend to move forward with these guys. So with that, I will leave it with you, Brad and Chris, to go ahead and run through your presentation.
That's great. Thank you very much, Heather. I really appreciate the invitation to join you, and we're glad to be here. Please do also jump in with any questions along the way. We'll cover as much information as we can, but if there's anything you'd like us to spend more time on as we go, we will be happy to do that. Just to provide an opening summary on what we have put together here, Spectra Capital has formed a new fund called Spectra Velocity that is, as you mentioned, in the commercial real estate debt market. It's what we call special situations, which means, generally speaking, the owner of the property, the potential borrower for our capital, is in some form of strain or distress. Typically, there's a looming repayment obligation on the existing debt, whether it's a refi at maturity, construction to permanent, whatever the case may be. They're on the clock. They're not able to refi timely and under what would be normal commercial terms. This strategy works in all environments. Chris has done this with his own capital for the last few years. So it's not purely opportunistic in the sense we set it up because we think the market's going to get bad and worse from here. But it happens that also is true. So I think our timing has accidentally been good. And however many borrowers there are who are in some form of strain or distress in a normal environment is unfortunately going to explode substantially here coming up, we believe, over the next year. So it's very timely for what we're doing. And when we see an opportunity like this, what we do is step in, take out the existing debt, pay off the bank, generally is what that means, take a first lien position, which is always the case. We always want to be the first debt, and in most cases, the only debt involved in a transaction, so we control the outcome of it. We reset the clock for the borrower. We have kind of medium-term bridge money, generally speaking, of call it 6 to 12 months is our average term. So it gives the borrower more time to go out and sell the property, bring in equity, arrange other longer-term permanent financing. It gives them time to pursue their options. We can move very quickly. That's part of the value of what we do. In a lot of cases, these property owners have little time to address the situation. You know, the bank's already issued a final notice. Maybe they've begun foreclosure proceedings. In some cases, it's not even the borrower's fault. Maybe they had other debt lined up and that debt backed out, which is happening more and more these days. But for whatever reason, they're under the gun. They need us to move quickly. We can step in and issue a term sheet within 24 to 48 hours on a deal that we like, and can close within 2 to 3 weeks. So that's a big part of the value of what we do. Our underwriting decisions are really heavily driven by the loan to value, the amount of the capital we're willing to deploy in a first lien position versus the value of the asset itself. Generally speaking, we're at 50% loan to value or less, meaning the property is generally worth twice the amount that we loan to it. We might go up as high as 60% in some cases, but we want a very large margin of safety between what we have in it and what it's actually worth, even in a fire sale environment. We're not loan to own. We're certainly not predatory. We want to help our borrowers stay in their asset and give them time to reset. We want and expect to be repaid, but in situations where the borrower can't or won't repay us, we're indifferent to the need to foreclose. We have a team in-house, including an attorney that's very experienced at the foreclosure and disposition process. We're willing to step in, take the asset, and then sell it out. We're not looking to hold it. We're not trying to build a portfolio here. And that also is a key differentiator. Many lenders, including banks in particular, are very reluctant to foreclose and have REO on their balance sheet. We don't want to do that, but we are willing to do that, and it's a core competency that we have. Because we're able to act quickly and solve problems for our borrowers, our capital is expensive for them. And some people have said we're a lender of last resort, which is probably true. People who can find better terms will take them, obviously. We typically price our transactions with interest rates in the high 20% on an annual basis, plus origination fees, exit fees, certain other expenses along the way, extension fees. And some people said, why would anybody borrow money at that level? And the answer is because it's better than the alternative, which is either to get foreclosed on and get zeroed out, or maybe bring in an equity partner to fire sale price and get diluted down to next to nothing. So compared to the options, our capital is actually attractive to our borrowers, and they're glad to see us show up. We actually have borrowers who are thankful for what we're doing as opposed to being aggravated about the cost of it. So when you put all that together in a broadly diversified portfolio, and we're raising $200 million in an open-end fund, which we'll talk about, it allows us to offer a target net return to our investors of 20% per year, which includes a 10% preferred return, which means that every calendar year, the first 10% in returns that we make go 100% to our investors. They get paid their 10% up front, which based on our return profile means roughly this time of year, April, May, every year, the investor would have anticipated receiving their 10% preferred return. And then we split the upside for the balance of the calendar year beyond the 10%, 50-50 with our limited partners. And we charge a 0% management fee. We don't get paid at all by our investors until we've already earned them the 10% for the year. And we believe that we can produce this with low volatility, consistent returns, and provide liquidity at the same time. That's one of the concerns that many investors have over real estate funds, is they often have a 3 or 5 year lockup to let the manager go out and acquire mortgages or buy properties and then liquidate it down the road. That's not what we're doing. We are deploying short-term debt. It gives us liquidity inside the fund. Anytime an investor wants out, we offer quarterly liquidity and they can access their capital, which we think is important also in this environment. People are adverse to having their money locked up for a long time. So that's a quick overview. Much more to come. Chris, anything you wanted to add to that?
I think you hit all the high points. I kept starting to jump in, and then he covered what I was going to say. So Heather, I'll start walking through the deck, and we can do this interactively. So if you feel like we've missed something important, or there's something that you want us to stop and talk about, or if anyone just has questions, we can, we can pause and address any of that.
Absolutely. Please do ask questions. We would welcome that. We've already,
I think you've already covered that.
One thing I will mention, Chris, from that slide, right there,
Sure.
The bottom one, which is important. Chris is the founder and CEO of Spectra. He built and sold a technology company a few years ago and was doing this with his own assets, as I mentioned, this kind of special situations lending. And Chris has already invested $1 million of his own money as a limited partner on the same terms as all the other limited partners or investors who come in will have. And most of our first investors are friends of Chris's or mine or other people involved. So we have aligned interests. We're taking care of Chris's money. We're taking care of our friends' money. We're taking care of all of our investors' money. And we think our fee structure and liquidity structure bear that out, which we'll talk more about as we move on from here.
Let me know if you want to skip a slide.
I'll just talk a little bit about the inefficiencies here, if we could. We're really addressing inefficiencies on several different sides. For borrowers, as all of you know in the real estate business, it takes a long time to close a real estate loan, especially a commercial real estate loan. And that is even more true now than it ever is. It's hard for borrowers to access capital on a timely basis, and that's especially true if they're already in some level of trouble. So we are helping provide efficiency to them in accessing fresh capital when they need it. Lenders, on the other hand, especially banks, have structural constraints. They can only operate inside a certain box according to the regulators. They have to look at cash flow in the property. They have to have a high credit borrower. The loan to value has to work. There are a lot of constraints around what they can do. We don't have those constraints. We have a tightly disciplined investment process. We have our own limits, but nobody imposes those on us. So we're able to be creative and responsive to what the market needs, as long as it meets our underwriting criteria. And then from the investor standpoint, from your standpoint, everybody wants to receive high levels of current income with little volatility. And that's obvious. It's a holy grail for an investor. And we believe we put something together that offers that kind of unique offering for investors. All right. Risk mitigation is probably one of the most important points. It's relatively easy to put money to work in the market. How do you make sure you get repaid and make a profit on it? How do you manage the risk? And that's really where this starts. First and foremost, it comes with the investment process we talked about. Low loan to value, high margin of safety, high level of comfort with the due diligence that we do on an underlying transaction. The first lien position is extremely important. We always want to be the one who decides what's going to happen with the property and how it's going to be valued, who's going to receive the proceeds. That's our call. We're not dependent on anybody else. We're broadly diversified. I mentioned we're looking to raise $200 million, which we are confident we will do by next year, certainly. There's a very good response to this. We'll raise the $200 million. When we get there, it will be deployed across 75 to 100 different transactions at a time. Our underlying target loan size is 2 to 4 million, even maybe 1 million. So you spread that across $200 million, gives broad diversification by geography and by property type, which is different than a lot of other kinds of real estate investments where you might syndicate one apartment building or a small group of apartment buildings with all kinds of idiosyncratic local risk. Here it's a lot of borrowers, a lot of properties, a lot of different geographies. We always have title insurance. We have a very thorough process of checklists that we go through before we close on an underlying transaction. We have the team in-house to do that, which we'll talk about. We have 8 people on board already, including
we may be at 11 now.
11. Chris has been busy this week while we're traveling, hiring new people, but we have a big team, including a lot of real estate expertise that we can talk about. And we have a third-party loan servicer, just to give everybody comfort that we're doing this on an arm's length basis. We have a third party looking over our shoulder and servicing the transactions. Yeah, we'll talk about the return profile a little bit. And I mentioned it just a minute ago about the syndications. When people think about real estate funds generally, there are typically a couple of categories. One are mortgage funds, where the fund manager will go out and acquire or originate a bunch of traditional first mortgages like a bank would. They typically use leverage to enhance the returns on top of that, which works great when it works, and then it doesn't. And that's produced rates in the 10 to 12% rate over the last few years, which is great. And they performed as they're supposed to. The problem is rising interest rates have not treated that market very well. And it's going to be very hard to continue to originate new mortgages that meet their criteria. I think you're going to see returns lag behind meaningfully for the next 5 years in the commercial real estate mortgage market. And then there's syndication with equity, which is what we described, where a number of investors come in and a general partner will buy some properties and then sell it eventually and cash everybody out. That typically locks up capital for a long time. It's done well. I mean, I'm sure all of you see it in your markets. Apartment assets have done very well. Values had been rising consistently. With higher interest rates, I think that game is over. I think it's very unlikely you're going to see attractive returns in real estate equity for the next 5 years, if any returns possibly. We're due for a period of a flat to down market for a while, which benefits us, which we can talk about. So again, it's done a good job, but it's not necessarily where I would want to put my money looking forward from here. And then there's what we're offering, which we think is an attractive hybrid. It gives the 20% target return, equity type returns, but it's all debt with a senior position and it's broadly diversified. And we don't use any leverage. We are not borrowing any money to produce these returns. We have the right to down the road, and we may if the situation changes, but right now we don't want to have any creditors ourselves. We want to be the creditor and in control, and we don't need to borrow money to produce the returns we're expecting to produce. We don't want the risk. So that contrasts us to some other things that people often see out there in the market. Right. Here's a case study. This is the last transaction that Chris did before he stopped investing for his own account and made the commitment to form Spectra and invest solely through Spectra, which he has committed. So do you want to talk about this?
Yeah, before I get into this, this particular property is in Puerto Rico, but we're looking at all 50 states, U.S. Virgin Islands and Puerto Rico, which are both territories of the U.S. This particular property is in Aguadilla, Puerto Rico, which is over on the West Coast. This is a light industrial property that some folks bought with the intention of stabilizing it, fixing it up and bringing in tenants. So this is a property that appraised for $4 million by 2 different appraisers as is, and then a stabilized value from one of the appraisers of 30 million. I lent these guys $1.16 million, which allowed them to take their original lender out. And this generated a 52% return for me over a 6-month period. So that's total return, not annualized. So this had an LTV of about 25%. We had all kinds of protections on this. So we had confession of judgment. We had a personal guarantee from one of the high net worth investors. There was a second note that they put up as additional collateral. So if this had not been repaid, I would have been just fine because there's plenty of equity there. If I had to take back the property, I ended up collecting a forbearance fee of $250,000 for an extra, I think it was 60 days of time. So it turned out to be a great transaction. These guys ended up lining up longer term capital. This bought them the time they needed, so they didn't get zeroed out. So it was a fantastic transaction all around. Not everything we do, in fact, most of the things we do aren't going to generate an annualized 100% return, right? But this is an example of transactions that we're seeing. So you have anything to add?
Yeah, just the one thing I will add, there are two reasons I think that's important. One is it gives a good idea of what a deal actually looks like, which is this. You have a property that's worth a lot more than the loan that goes into it. First position, take out the existing debt, all kinds of other backstops of the personal guarantees and confessions of judgment and so forth. But I think it's also important because it shows the motivation of the borrowers, which Chris addressed. In this case, the owner of the property had syndicated this. He brought in something like 20 of his friends to invest alongside him. The existing bank debt was about to foreclose. So he was at the risk of zeroing out himself and all of his friends on the deal. A terrible outcome. Their business plan wasn't working. They were trying to rehabilitate the property and stabilize it so it could get leased up, which would have and still should create a lot of extra value, but it took too long and they're out of time. And so we were able to step in. Well, Chris stepped in this case and got it all reset. And the borrower was grateful, as Chris said. He and Chris are still good friends. So that's why people would borrow from us.
All right. So this is a typical, this is what we call our lending box, right? So these are the terms that we generally stick to. This is the kind of things that we lend money on, right? So like I mentioned earlier, we're looking at all 50 states, Puerto Rico, the U.S. Virgin Islands. In terms of focus areas, we're not doing any office, but we'll do just about anything else that's commercial. So we'll do multifamily, self-storage, flex space. The one I just showed you was light industrial. We'll do land as long as it's infill, meaning that we don't do agricultural land or things that aren't surrounded by developments. Our transaction size eventually is going to scale up to potentially 20 million at the top end. Right now we're focused on kind of 1 to 50 1 to 5 million. In terms of let's see, rates. So our stated rates are typically in the high 20s, and then we'll charge an origination fee on top of that. It's typically 2 to 6%. We'll charge an exit fee that's 1 or 2 points. All of our loans are recourse. So in addition to being secured by the property, we get personal guarantee from a principal involved who's got most of the time has significant assets. And one key point here is that these are pretty short-term loans. So our PPM allows us to go up to 36 months, but 3 to 12 months is much more typical. So one nice thing about that is that we don't have what's called duration risk. So if we were doing longer term notes, there'd be risks that we'd be locked into a transaction where that wouldn't be favorable for us as interest rates or asset values change over time. But since we're doing short-term loans, we don't really have that risk. We're able to continuously reprice as things change. And it says closing time of under 30 days. We generally try to issue a term sheet in a couple of days. We've got the horsepower in-house to do all of the underwriting very, very quickly. And we try to get stuff closed inside of 2 weeks, which for commercial loans is very, very quick and is one of the reasons that we're able to charge so much for our capital.
Yeah, thank you. The only other comment on that is on the size. We really like this part of the market. The $1 to $2 to $4 million properties. It's much too small for the hedge funds and the big institutional investors to look at, so we don't see competition from big money. But it's also too big for the borrower who's in trouble just to pass the hat with his friends and family and get bailed out. It's too much money. So we're really in a sweet spot with an inefficient part of the market, not a lot of competition, and frankly, a lot of pricing power for our money.
We talked about low LTVs.
Let's talk about the origination for 1 second, if we could. A lot of people ask us, where does your deal flow come from? How do you see all these different transactions? And it's really from several different channels. As we are just getting started, we launched the fund last month. We've already closed a number of investors. We've closed several deployments. Where are we seeing it? It's coming in right now, mostly from personal networks. Chris's relationships, our real estate attorneys' relationship, our real estate professionals' relationships, and we'll go through their bios in a minute. But we put the word out, and all of a sudden, flow keeps coming in. We really haven't even had to broadcast it or advertise our availability yet. We also have relationships with brokers. The commercial real estate brokers are sending us transactions, again, from existing relationships. And that channel is important to us because we don't have a lot of competition. So brokers like sending us deals that fit what we do. And then also with Chris's data and technology background, ultimately, we're going to build out a system that maps all the commercial real estate in the country with debt on it and be able to track the debt obligations and the maturities. And it will allow us to use technology to spot origination opportunities before maybe even the borrower knows that they're in trouble.
Right, but we haven't started building that because we've got more deal flow than we need to do with right now. So,
Right.
but most of everything that we're getting today is either coming through the network of one of our principals. We've got 6 partners, or the broker network that we've got. But it is an important point about the technology because long term we expect to source capital through that channel. Once things go back to the way they were a few years ago when rates were lower.
Okay, we'll talk about the fee structure and liquidity, and we kind of touched on this a little bit earlier, but we do have an unusual fee structure, and we offer an unusual degree of liquidity. As mentioned, we have no management fee at all, a 0% management fee. We have the 10% preferred return that the investor receives every calendar year. And then beyond the 10% return, we split the upside 50-50 for the balance of that calendar year, and then start again the next year. The origination fees that come in on each transaction, we receive as a general partner the first 2% of each origination fee. Then everything above that and all other income and fees go into the limited partnership vehicle. So basically, our borrowers are paying our overhead. We're not asking our investors to pay us to do our jobs. That's coming from the borrowers themselves. And then beyond that 2% origination participation, everything else we all split on the pre-established basis. And then the liquidity we also touched on, but no lockup, quarterly liquidity. Anytime somebody needs all or some of their money, they let us know with appropriate notice, we can get them out. And we intend to pay quarterly distributions on an ongoing basis. So which can either be reinvested or taken as income. So it does provide cash flow, assuming we hit our target returns at an attractive level. And this can be held in an IRA also for people who are tax sensitive on this. We have certain limits on how much IRA money we can take compared to non-IRA money, but we absolutely are able to do this inside IRA account. Okay. We talk about the team now.
Yeah.
Go ahead if you want.
Sure. So we have a fantastic team. Everyone on the team has substantial experience in either commercial real estate lending or asset management. So Craig Lawrence, our founding partner, spent his entire career in commercial real estate as an attorney. He was the one who was papering up my deals before we set up the fund. He's a rare situation where he's both a fantastic lawyer and a fantastic business operator. We're very happy to have him on the team. Patrick comes to us from New York. He's got over 20 years of experience in commercial real estate lending, specifically in hard money. So he's our chief lending officer, and he's the one who kicks off the origination process and then works with the rest of the team to underwrite deals. Brad, who's sitting here with me, has got 25 years of experience in asset management. Daniel Sanabria has a CFA. He's actually our CFO. This is an old version of the deck. And has, substantial experience in asset management, and also has served as a professor of finance. He's more than qualified to be doing what he's doing for us. Jack Cruppy is our portfolio manager. He's got interesting experience because he's got over 2 decades of experience in commercial real estate, but he's also run his own fund. And he worked through the 2008 crisis, working on a book of business where they were managing over $1 billion of assets. And he navigated that quite well. So these are our 6 partners. We've got people in addition to that help with underwriting, both on the team and external experts that we pull in for various purposes. But I'm thrilled to be working with all of these guys. You have anything to add?
No, I think that's it. Thank you.
Yeah. And for what it's worth, one last thing I want to point out is that we've got top flight vendors in pretty much every category. It's not just the team of folks that we have in house. We've taken great care to select the best people to partner with as vendors. So Jurassic has an amazing reputation in this space, representing funds like ours. Opus is our third-party fund administrator. We're using Spiegel, who also has a fantastic reputation as an accounting firm. And then we're, like Brad mentioned earlier, we're using FCI as a third-party loan servicer. City National Bank is a subsidiary of RBC, so they're in over 30 countries and have in aggregate over $1 trillion in assets. So anything else?
No, I think that's it. That covers the presentation, all of our prepared comments. We would welcome any and all questions, or happy to dig into any of these topics in more detail. Heather, I guess I'll turn it back to you to moderate, please, from here.
Sure. Well, there was a couple of things, that people were texting me during the presentation about what is it that I like. As you guys know, I talk to a lot of syndicators. One of my favorite things about what you're doing is, number one, I think the timing in the market is perfect. And number two, even when you lose, you win. Sometimes you win bigger even when you lose in this scenario, right? With the leverage that you guys are taking, or the loan to value, I should say, that you guys are taking, not leverage. So I found all of that super interesting. Another bit of feedback that I've gotten from a lot of people who I've talked about syndications with is that they want the option to get out, and that doesn't really present itself in most syndications, whereas with you guys it does. And additionally, with the opportunity to reinvest your distributions, you really have a compounding effect, which a lot of syndications also don't do that, because they may not be paying out their preferred return, so you're just accumulating it, but not compounding it. So for those reasons, as well as some of the others that you mentioned, that's why I really wanted you guys to come present to the group today, because I just think the timing is great. One thing we didn't talk about is the minimum, and then a potential feeder fund. So would you like me to speak to that, or do you guys want to speak to that?
I'll go ahead and make some comments, Heather, and then you can add on as you would like to. Our stated minimum is $250,000 per investor, but we formed this relationship with Heather. We very much would like to work with her and all of you, and have worked out a solution where a close associate of Spectra Capitals, who is an asset allocator to alternative investments, is setting up a feeder fund for investors who have less than $250,000 to be able to come in together and aggregate that. And so Heather's working out an arrangement with that party now that should be done here in the next few weeks, it looks like. And even if for some reason that doesn't transpire, we have some other options with Heather that we can pursue too. But we can offer a lower minimum is the point. Heather, I'll let you kind of address that more if you'd like.
Well, I just want to say specifically how much lower, so people know what to expect.
Sure.
It's going to be 25,000 is what we're aiming for. Everyone says aim higher, but I think for me personally, there's a comfort zone, and I know a lot of people haven't invested in this type of thing. So offering an opportunity to get in at $25,000 is a little bit less scary for some people. Obviously, you can go higher if you want to, but we are going to bring it down that low. So I think it's really an opportunity for anyone who's interested to get involved.
Okay, great. I see some comments coming in. They're flashing pretty quickly, but I saw one about the subscription process. Do you want us to go ahead and address that?
Well, I think I think there was a question about the qualification
Okay.
process. So one key point there is that even through the feeder fund, it's going to have to be accredited investors only. So we're not able to make exception. You know, I think that's worth pointing out.
Yeah.
So the definition for that, I think, is $1 million in net worth, or is it
$300,000.
always mess this
in
up?
combined.
Yeah, 300,000 in combined household income if you're married, or 200,000 if you're not.
Right.
Is that right?
Right. And or $1 million of liquid investable net worth. That's correct. Yeah.
Not counting the household, or
Right,
sorry, not
not
counting the
house.
primary home. Yeah.
Right. And because of the type of securities issuance we're doing for this fund, an investor who is accredited would need to submit an attestation form that's signed by a CPA or a lawyer or an investment advisor. It used to be an investor could self-certify as accredited, but that's no longer the case with what we're doing. So yeah, everybody would need to be a verified accredited investor.
Does that answer the qualification question, or? I'm not sure who asked that. I'm sorry.
Okay, yeah.
I have a question.
Yeah, go ahead, please.
Sure.
To be qualified, let's say you have 3 funds and it equals over $1 million. Is that okay? Do you have to have $1 million liquid in one fund? I mean, like one
It
investment.
doesn't have to be liquid. You just have so it's either or. So either 300,000 in combined household income with your spouse, 200,000 in income if you're single, or $1 million in net net assets. Yeah,
Investable assets.
investable assets. So not counting your primary residence. So if you've got, you know, investments in funds, you know, anywhere that add up to $1 million, you're more than qualified.
It doesn't have to be liquid, and it doesn't have to be in one place.
Yeah, and that's not our requirement. These are regulations under Reg D
The
that
SEC.
govern how we're able to, you know, raise money.
Hey, can I ask you a question real quick? I came in
Sure.
just a little bit late and you put up a confidential thing. I didn't read that, but I'm assuming we can share this with other potential investors. Is there anything you said today that would be proprietary for this group?
No.
It's not proprietary. I mean, we'd like to be in touch with the people that are getting copies of our deck, but you're more than welcome to share it. We'd
Yeah.
appreciate an introduction if you don't mind, just so we know who's getting it.
Yeah.
Yeah, but we'll send out the deck. If Heather doesn't already have a copy of that, we'll make sure she does. And she, you know, you guys are welcome to distribute it. We just appreciate it as a courtesy to know where it's going.
And we'd appreciate not sending it to other real estate asset managers too. There's no point rubbing their face in what we're doing. So, all right.
Gotcha. And second question is, what was your end game on the property in Puerto Rico? Did you flip that property, or who owns that property today?
Yeah, so this is an important point. So we're on the debt side, not on the equity side. So we're not buying properties. We're making loans that are secured by properties. So in this case, the loan that I made was refinanced with a longer term financing solution. So what we're doing is making short-term loans. You know, and that's part of why it's expensive. We're acting quickly to kind of help people in situations where they're up against the clock.
Yeah,
And then the goal is to be taken out by their long-term investors. If that doesn't happen, or sorry, long-term lenders, if that doesn't happen, then, you know, then we will end up taking the property back and selling it. And so that's why the LTVs are so important, because we're you know, loaning money at a fraction of the property's value. So we have to take the property back. Depending on the jurisdiction, we'll either get all of our money, principal and fees back, or in some jurisdictions, we're able to keep the rest of the equity when we sell it for an even greater profit. But we prefer, of course, to be repaid.
Yeah. Thank you.
Does that answer your question?
Thank you.
Thank you.
Chris, Brad, just for comfort's sake, I don't know if you can speak to the fact that some RIAs are actually deploying money to your fund. I don't know if that's something we can speak to yet, or it may give people comfort if you can.
Yeah, I'd be happy to share a little bit of background there. I've been involved in starting different kinds of alternative investment funds before. And generally speaking, it takes a while for registered investment advisors or financial planners, wealth advisors, however you want to categorize them, to be willing to allocate to a new fund. They typically need a fairly long track record, a certain critical mass of assets to just kind of qualify. I've been very pleasantly surprised with Spectra and what we're doing now. None of those old rules really seem to apply. what we're doing because of the margin of safety of the assets themselves and the quality of the team we put together and the timing in the market has caused some of these professional allocators to be interested in working with us much earlier than they otherwise would. And we already have 2 allocators who have done extensive due diligence on us and are introducing their clients to us and preparing to make allocations right now. And we have a couple more that are in the midst of that process also. So we're pleased and grateful to get professional sponsorship this early on.
All right, well, we've got more time. If anyone
Sure.
else does, we're happy to field questions.
Thanks for answering that, Brad.
Sure, my pleasure.
I don't know if there are any more questions at this point. Everyone knows how to reach me. These are all people I personally know. So, so just email me if you want to know more. I will put my email in the chat just in case anyone doesn't have it. But yeah, just email with any further questions. Like I said, I'm personally planning to invest in this regardless of what everyone else does. But we'd love to have people join me on the journey. So.
All right,
Thanks.
well, we definitely appreciate everyone's time. We know that everyone's busy and are thankful for the audience, and you know we are pretty accessible and open books. So you're welcome to reach out to Heather or either of us at any time. But thank you guys.
Yeah, we're excited to work with Heather and all of you. And if anybody has one-on-one questions, we're happy to set up additional calls after this. I'll be pleased to talk with Heather and anyone else who would like to follow up from here. So thank you.
All right,
Thank
sounds
you.
good. Thanks, guys. I really appreciate your
Thanks.
time.
Thanks, everyone.
All right,
Take care.
have a
Thanks,
great day.
Heather. Bye.
Bye-bye.